Today's Talk About It Tuesday question is, if the 10-year average of the S&P 500 is about 15% and real estate has averaged about 12% over the same period, why do you suggest having some money in a high yield savings account that only averages about 3%? Why not put all of your money where it will get the highest return? That's a fair question, but it takes some understanding of how the economy works, and it takes some understanding of why we have to spread this out. And so let me just give an analogy like sports. So if you play football, basketball, soccer, hockey, baseball, you're trying to rack up as many points as possible. That's the offensive side. But there's another side to it. If you don't play defense, if you don't have a defensive side, you can still lose the game no matter how many points you put up offensively. If you don't play defense, you can lose. So I look at a high yield savings account as playing defense. And why do we have to play defense? Over that period, it averages that. But there are periods in that 10 years where it can get way more. But there are periods when it's also down. So if we go back and use our greatest example in recent years, the Great Recession, real estate bottomed out tremendously. It dragged down the stock market with it. So those who had cash were able to survive. Those who didn't have cash had to sell their assets, their real estate, their stocks at a depreciated value, meaning they sold it at a loss because they were desperate. They couldn't hold on to it, and they couldn't survive because they didn't have a defensive position, meaning a cash position. Even if you're not in a recession, you don't want to have to sell an asset for an emergency. So your emergency fund is playing defense, right? You have a cash position for potential emergencies. You have a cash position, again, when the economy goes down. And the older you are, the more important it is to have a bigger cushion because you don't have time if you sold your assets to regain value. So if things go bad and it lasts 2 to 3 years and you're older, you want to have 2 to 3 years of a cash position. And yes, it only gets about 3%, maybe 4%, but that will cover the cost of inflation. The inflation rate is 2 to 4%. So at least you'll have cash that hasn't devalued sitting there able to be used. The other aspect of it is because those assets depreciate, those who are in a cash position can scoop in and buy those assets at a depreciated value from the people who didn't have a defensive position. And when it inevitably turns around, you'll make a tremendous amount of money because in a recession, cash is king. So to review, we need a safe position, meaning extremely low risk. The higher the risk, the higher the returns. The lower the risk, the lower the returns. This is extremely low risk, but it has extreme low return. It mitigates against or hedges against inflation. So you're not going to have devalued money that's there. It's pretty much maintained its value. If the assets are depressed, you don't have to sell them at a depressed value. If it's a prolonged recession, you can actually use your cash to survive on. And finally, if you have a cash position, when those assets go down for everyone else, you can scoop in and buy them at that lower rate. So when it does return, you're at a higher rate. So do you have a large cash position? The older you are, the larger cash position you should have. Very small when you're young, just really your emergency fund and enough to scoop up some opportunities. But when you're older, again, and you can't play offense too much longer, you want a larger defensive position and a smaller offensive position. But everybody needs to have that cash position. It's your safety net. It's your defense. It's your protection. It's your low risk. And it has to be part of your portfolio. But again, the older you are, the larger that position is, the more defense you're going to play, the more safety net you require. But it's important. You have to have that as a part of your portfolio. So I know, like, emotionally, you just want to take the risk and put it where the highest return is, but you don't know when an emergency is going to happen. You don't know when the economy is going to bottom out. Things that are happening now could cause this whole thing to crash. War, right? Prolonged wars make it happen. We saw a big drop when we had the COVID crisis. We saw the economy bottom out. There are things that can happen, at the drop of a dime that can really turn this thing upside down. So you can't wait to create that defensive position. It has to be in place. So you can't put all your eggs in one basket. You got to diversify. You got to have a defensive position. So that's the reason. Okay. So I'd love to hear your thoughts on it. Please like, share, subscribe. Keep the questions coming, and I'll see you next Tuesday.